Now let's talk about the basics of trading stocks. To trade means to buy or sell in the financial market, and if you want to trade the stock, you will have to open a brokerage account. Nowadays, you have a lot of options. You can go to, for example, Fidelity.com, CharlesSchwab.com, and just open a brokerage account online. So, for example, if you open an account with Fidelity and you place a buy order, your buy order would go through Fidelity to a market maker or a specialist, depending on where the stock is traded. When you try to buy or sell a stock, you will also see the market prices for those stocks. So the bid price and ask price, we talk about these for the bond prices. Similarly, for stocks, bid price is the price at which the dealer will buy, and ask price is the price that the dealer asks, or say the price at which the dealer will sell. So if you want to buy, you actually will pay for the ask price, and if you want to sell, you will sell at the bid price. The difference between the bid and ask prices is what we call as a bid-ask spread, and that is the profit for the market maker. And when you try to place an order to buy or sell the stock, there are different types of orders that you can place. We will talk about market order and limit order in this class. Keep in mind there are other orders such as the stop loss order, but in this class we'll just mainly talk about the market order and limit order. A market order is an order that you make to buy or sell a stock immediately at the best available current price at the market. So when you place a market order, your market order is very likely to be executed because it doesn't have any restriction. So a market order guarantees execution. You can also place a so-called limit order. A limit order is an order you place to buy or sell a stock at a specified price, or even better. So you specify the price that you want to buy or sell at. For example, here, this is actually a screenshot from Robinhood. So if you have the app and you have an account with Robinhood, and if you want to place the limit buy order, you will see this screen. So for example, you want to buy 4 shares of this stock called RAW. You want to buy it at $11.54 or lower. So this is a price you specify. If the current market price is 11 now, it doesn't make sense for you to set a limit price of $11.54 to buy it at a high price, right? So usually you set the limit buy price at a number that's lower than the current market price. So the benefit of placing the limit order is you get the price that you want. So you're not paying more than what you are willing to pay. You're not receiving less than what you are willing to sell for. However, because this is not a market order, if the price set by you cannot be matched during the period of time, for example, if you set the limit order for today and today goes by and by 3 p.m. Central Time, the price still is not at the level that you want, then you will not be able to have your orders executed today. So the execution of the limit order is not guaranteed. So you may lose the opportunity to buy or sell your stocks if you set a limit order. What kind of information do we get when we try to look at the quote of a stock? So when we look at this picture, we see this is about McDonough stock. The company is McDonough Corp, and the ticker symbol is MCD. So McDonough is traded at MYSE under the ticker symbol of MCD. According to the picture here, at this particular time, McDonough was traded at $99.15. This is the current price, or say the last price of McDonough stock, and that was 0.39 or say 39 cents higher than last day's closing price. And that is also 0.39% higher than last day's price. You can also see some other information. For example, during that day, the lowest price for McDonald's was $98.54, and the highest is about $99.18. So the stock price has been moving up and down in this range within this one day. Now, within the past 1 year, I'll say in the past 52 weeks, the price has been up and down within $83.31 and $99.50. You can also see some important information about the stock, such as the PE ratio, EPS, that's earnings per share, dividends. The company actually paid about $3.08 dividend per share in the past year, I'll say past 12 months. So the dividend yield, which is something we will explain a little bit more later, is about 3.1%. You also see the trading volume here, so it's about 2 million. So that means more than 2 million shares of McDonald's stock were traded in the market during the previous days. So that is to give you some basic information for the McDonald's stock on that particular day. Now let's get down to some calculations and look at the basic stock valuation. If you recall from the previous chapter, we tried to estimate the value of the bonds based on the present value technique. So here we'll use the same principle to estimate the value of the stocks based on the total present value of all the dividends and a final sale price for the stock. Now the problem is that bonds do have a fixed amount of coupon payment, so it's easy for us to know how much investors can receive as coupon payments and also par value payments from the bonds. And also bonds have maturities, so we know how long investors can receive those payments. However, all those information are kind of unknown or uncertain for stocks, because if stocks do pay dividends, we don't know how much they're going to pay and for how long they're going to pay the dividends. If you try to sell the stock in the future, we don't know how much would be the price. So these cash flows for stocks are more unknown or uncertain, which makes stock valuation more complicated and more challenging than the bond valuation. And that is a fact. But we'll try to deal with it, and we'll start with the easiest case. That is when we have some good idea about the future selling price and the dividend payment of a stock. So let's look at this example. If we have a so-called 2-year horizon, that means we buy the stock now and we hold the stock for 2 years, and we will sell the stock at the end of the second year. When we try to sell the stock at the end of the second year, we receive a price from selling it, and we will call it P2. Within these 2 years, we receive 2 different dividends at 2 different times, 2 different years. So the first dividend we receive at the end of the first year, we'll just call it D1, and second dividend, we'll just call it D2. And now we have this timeline pretty clear. If we can receive one dividend payment and another dividend payment within 2 years, and then at the end of year 2, we will receive a sale price from selling the stocks at the end of year 2. Can we calculate the present value of these future cash flows, including 2 dividends and a final sale price? This, if you think about it, is a typical Chapter 5 question of calculating the total present value of multiple cash flows. So for D1, we discount it, calculate its present value. For D2 and P2, because they are both at the end of the second year, we can sum them up and calculate the present value. And to calculate the total present value, we just sum up the 2 different present values, and that's how we get P0 today. So again, how much we are willing to pay for it today, the price of the stock, depends on how much we think we can receive from the stock in the future. In this case, if we have 2 years, we have 2 years of cash flows, and our job is to calculate the total present value of these 2 years of cash flows. We can also extend the question into, say, 3 years, 5 years, or even 10 years. So for example, if n is 10, that means we're holding the stock for 10 years and try to sell the stock at the end of year 10. And if that's the case, we will receive D1, D2, D3 till Dn, all these dividends at different times. So we will discount all these one by one, calculate its present value. And last year, it's a little bit different because you will have the last dividend payment and the sale price. So again, this is a process of figure out a total present value. Now, if we look at this example, if we have a company that is expected to pay a dividend of 1.35 next year, so 1.35 as D1, and 1.5 the following year, 1.5 as D2. After that, if you sell it, you will receive $68 in 2 years. So first year, $1.35. We discount it using 10% required rate of return to get its present value. Second year, we have 2 payments, the dividend payment and the sale price. We sum them up because they are both at the end of year 2. We calculate its present value by discounting 2 years back. And then we sum up these 2 present values. We get the price, that's P0, according to D1, D2, and P2 in a 2-year time horizon. In the last example, we try to hold the stock for 2 years and sell it at the end of the second year. What if we decide to hold it for 5 years, or 10 years, or even longer? If we keep extending it, we can actually have an infinite number of years. And if that happens, we don't have a future selling price. All that we have is the infinite number of dividend payments. So that would include D1, D2, D3 till D10 and D100 and D forever. So the price today, P0, will be based on the total present value of all the future dividends till the infinite future. But the problem in this equation, as you can see here, is we cannot really get a result from this. So to make this equation work, we need to make some assumptions. Here, we introduce the constant dividend growth model, and this is based on the assumption of constant perpetual growth of dividends. So dividends are assumed to grow constantly, or say at a constant growth rate, which is the little g here. And this constant growth rate is supposed to last forever. That's what the perpetual means. If all the future dividends satisfy this assumption, the long equation we have here actually can be simplified into a very short formula here, which says price today, P0, is D1, the dividend of next year, divided by I minus G. I is the required rate of return for stockholders, and G is this constant growth rate of dividends. And this equation is also called the Gordon growth model. For this class, all you need to know is that this Gordon growth model is derived from the previous equation of calculating the total present value of D1, D2, Dn, and D forever if the dividends satisfy the assumption of a constant perpetual growth. So in that constant dividend growth model equation, again, G is the growth rate, and it's supposed to be constant and perpetual. D0 is the most recent dividend. It could be the dividend paid this morning, or yesterday, or earlier this week. So anyway, recently paid. And D1 is supposed to be the future dividend. That will be the dividend that's supposed to be paid at the end of the first year, 1 year from today. For the constant dividend growth model to work, as we mentioned, constant growth rate that is supposed to last forever from the first year to infinity. And also, we need the required rate of return, I, to be greater than the G growth rate. Because mathematically, remember in the denominator is I minus G. If I is actually lower than G, then the stock price result will be negative, which doesn't really make sense at all. In other words, G is supposed to be lower than the I. This also means G is not supposed to be very high. If you are looking at a company that is currently experiencing a 20%, 30% high growth rate, maybe that would not last forever. Or say it would not be the constant growth rate. Apparently, the constant dividend growth model here cannot be applied into those high growth rate situations. That's why later in the next video, we'll introduce the extension of this model and talk about the valuation of stock under the so-called variable growth. Now let's look at an example using this formula. If we are looking at this company that just paid a $4 dividend, pay attention to the wording here. Recently paid or just paid. So that $4, would be D0. Dividend is expected to grow at 9%, so 9% is the little g. What would be the price of the stock if the required rate of return is 14%? So 14% is the little I here. In this question, based on the $4 D0 and the 9% growth rate, next year the dividend D1 is supposed to be $4 growing by 9%, which gives us $4.36. So P0 equals to D1 divided by I minus G, which is also D0 multiplied by 1 plus G, and then divided by I minus G. So you see we are having 4.36 here in the numerator instead of just $4. So the final result for P0 here is $87.20. Now let's think about a special case when G is 0. When G is 0, then dividends are growing at 0% growth rates each every year. That is telling us the dividend amount in the future will all be the same. That's actually the case of preferred stock dividends, because preferred stock dividends actually are fixed, same amount all the time. Sometimes we call the preferred stock a hybrid security because it has some feature of a bond and it also has some feature of a stock. The fact that preferred stock dividends are fixed, that's like the bonds because, as you remember, bond coupon payments are fixed. However, preferred stock dividends do not have maturity. That's different from bonds because bonds do have maturity. Some other facts about preferred stocks include that preferred dividends are cumulative, which means if a company skips one preferred stock dividend this quarter, the next quarter they actually have to make up and pay the preferred stock dividends to preferred stockholders first before they pay any money to the common stockholders. Not all companies have preferred stocks. Actually, only a small number of companies nowadays issue preferred stocks, and preferred stock is primarily owned by other companies instead of individual investors. And when companies own other companies' preferred stocks, 70% of the dividend income actually are tax exempt. So that's actually one of the incentives for corporations to investing and hold other companies' preferred stocks. The last point about preferred stocks is that preferred stockholders, unlike the common stockholders, they do not have the voting rights. So they have rights to receive dividends, and they do receive preferred dividends before common stockholders receive the common dividends, but preferred stockholders do not have the voting rights. Now let's go back to the constant growth model and think about preferred stock valuation. When G is 0, I minus G will become I itself. And at the top, D0 multiplied by 1 plus G will become D0, which is also the same as D1 or D2 because, again, they will all be the same. So preferred stock valuation essentially is the constant dividend growth model when G is 0. And again, when G is 0, preferred stock price will simply be the dividend of the preferred stocks divided by I, now the required rate of return for preferred stock holders. Once you understand that, the calculation is quite simple. For example, if we are looking at this company that pays $3.50 as annual preferred dividend, and the required rate of return on the preferred stock is 6.8%. All that we need to do is 3.5 divided by 6.8%, and the result is $51.47 as the price of the preferred stock. By the way, if you remember from chapter 5, this is like the equation for something called perpetuity. So preferred stock dividend is a series of perpetuity because of the fact that preferred stock dividends are the same amount and they are supposed to last forever. So we just talk about the constant dividend growth model. P0 equals to D1 divided by I minus G. If we know the future dividend payment pattern and the required rate of return for stockholders, we can estimate a so-called fundamental value of the price. If we look at the equation from another angle, that is, if we know the stock price, if we buy the stock at this price and we hold the stock, what is the return we can expect from this stock investment? If we rearrange the formula, assuming that we know the P, price, then I, the return, can be solved as D1 divided by P0 and then plus G. So that is telling us that if we know the price, we know the future dividend payment pattern, then we can have some good idea about the return that we can expect from this investment if we pay the price today to buy the stock and hold it in the future. Now the D1 divided by P0 part is what we would call as dividend yield. So dividend yield is simply about the return from dividend. If we pay the price today, and next year we're going to receive this much dividend, so the yield from dividend is D1 divided by P0. Now you may understand that when we look at McDonald's stock, what this dividend yield of 3.1% mean for the investors of McDonald's stock. The second component here, G, can also be considered as the so-called capital gain yield. Because if dividends grow at this constant rate, then stock price will also grow every year at the same growth rate. So then, if this year you buy it at P0, and then next year, how much would the stock price go up? It will go up by the same growth rate of G, and that's why the so-called capital gain yield is also the same as the dividend growth rate for stocks that do have constant growth in its dividend. So now, if we look at this example, if we are paying $30 P0 for the stock, and the stock will pay a $2 dividend at the end of this year, which is D1, and the dividend will grow at about 5% growth rate. So we plug in those numbers into this formula. The return turns out to be about 11.67%, which tells us that if we buy this stock at $30 and hold it to receive the dividends in the future according to the 5% growth rate in the dividends, then every year we expect a return of 11.67% from this investment. Out of the 11.67%, 5% is from the price appreciation, or say the capital gain yield, and the other 6.67% is actually from the dividends